Okay, so this bit was a bit of dill that I give you back, probably the first tip now. You were to go away and look up capital and revenue expenditure. However, I don't think it was done very well, or maybe we've forgotten. So let's have a quick recap. So revenue expenditure, well, expenditure just means spending money. So revenue expenditure means spending money that results in the day-to-day profits, so the day-to-day trading, sorry. So stuff like rent, stuff like electricity bills, stuff like buying goods, all that is revenue expenditure. And revenue expenditure goes on the income statement, and it's got short-term benefits. So like electricity is for the short term, lighting is for the short term, rent is for the short term. Some examples, I've just mentioned some. So utilities, rent, electricity, all those kind of stuff, all the expenses in that income statement. Maintenance and repairs to non-current assets. Whereas capital expenditure, this is kind of like more long-term. So this is when we spend money on non-current assets. So either purchasing them, improving them, installing them, getting them delivered to us. So it's all to non-current assets. Now this is the bit where we get tricked in exam questions. So if it mentions that a non-current asset costs £10,000 and it costs £1,000 to get delivered, you have to combine those figures and say that altogether it's worth £11,000. Yeah, it's a long-term benefit, and all the costs of the non-current asset, including the delivery and installation, stuff like that, all goes in the statement of financial position. Now there's 5 main forms, so I remember it as the phrase I dial. So the first one, installation of a non-current asset, delivery cost of a non-current asset, improvements of non-current assets. Now by improvements, that doesn't mean repairs. So if something's broken, that's a repair. Whereas if you want to do an extension to something, that's an improvement. If you want to put your company logo on the van, that's an improvement. Stuff like that. If you want to buy new software for a computer, that's an improvement, not a repair. The actual cost of purchasing the non-current asset is obviously capital expenditure. That's the main one. And any legal costs required in order to purchase it. So you add those 5 costs together, and that would be your non-current asset cost figure. So let's look at an example. So Murray Traders purchased a new delivery van, and there's all the different costs. So we've got the cost of the delivery van, we've got the insurance of the van, we've got adapting the shelving to create more storage space, first tank of fuel, road fund license, and painting Murray Traders and the business logo on the sides of the van. So have a think, which of those do you think would be revenue, so short term, and which of those do you think would be capital expenditure? So that would actually be part of the non-current asset. So the capital expenditure will obviously be the delivery van, so buying the asset itself. Adapting the shelving units to create more storage space, that's an improvement, so that would be capital expenditure. And painting Murray Traders and the business logo on the sides of the van, again, that's an improvement. Sorry, the second one, you could class that as installation as well, I guess. So you would add those 3 costs together and get 18,140, and that would be your capital expenditure. So you would debit the delivery van by that amount of money, and then you would credit either the cash, the bank, the trade payable, however you're getting the funds to pay for it. So on your statement on financial position, you would list 18,140 as the cost price for the delivery van, not just the 17,400, the total. And the revenue would be the rest. So insurance, that doesn't affect the cost of the delivery van. That's something you have to pay each year. The first tank of fuel, again, that's short term. And the road fund license, again, that's short term. So you add those together, and that will go in the motor expenses account of 1,050. And again, you would credit the bank or the cash account. And there's just a summary of the main ones. So for delivery van, you have the purchase and delivery cost, modification to the van, painting of the company logo on the van. That's all capital expenditure. Whereas for a revenue expenditure, you've got road tax, you've got insurance, you've got fuel, you've got service and repairs and MOT, and you've got the driver's wage. For machinery, the capital expenditure is the purchase and delivery cost, as always, and installation and testing of the machine. Whereas the revenue expenditure, you've got the fuel, power costs, the insurance, the maintenance and servicing, repairs and replacement of worn out parts, operating costs including wages, and the initial staff training.